All right. Tone, could you confirm that my audio is okay and you can see everything?
Yeah, it's good.
And then let me ask one thing, just out of curiosity. When I share screen, do you also see the sidebar with your own videos, or you see only my slides?
I think there's no the upper bound and lower bound maybe disappear.
Excellent, excellent. Okay, wonderful, excellent. So Zoom is very smart. I can see you guys, but you can see all the text and everything. That's great. Okay, right. Again, thank you for the invitation. I know that we have only 1 hour, so let me go ahead. This is joint work with 3 wonderful PhD students here in Bocconi. Isabella is going to be on the job market in a few weeks, and the other 2 students instead are younger. Yeah. Okay, so let me just give you a little bit of background motivation and then move on. So why do we care so much about studying pandemic events? Well, they tend to have a terrible negative impact on the wealth of millions of people. That's why we care about it. And so far, there is really nothing new. This is all stuff that you have already seen. Another reason why we may be interested in studying what happened with COVID-19 is that this is no longer an episode, an event, in the sense that, okay, pre-1980, it is totally true that we had pandemic concerns on average once every 20 years, and they were lasting about 20 years. But post-1980, actually, these events have become much more frequent, okay? And they tend to have a duration of about 2 years. So long story short, I think that our study is important because it can tell us something about future, unfortunately frequent pandemic episodes. Another thing that is special nowadays is that we are exposed to a lot of announcements. And these are not strictly economic announcements. These are periodic medical announcements, related to either pandemic-related policies, or just to the evolution of the pandemics. Okay, so here it is. All of a sudden, in March of 2020, we were all stuck in our apartments, and I was trying. This is an inside story. I was also trying to understand how to rebalance my retirement portfolio to avoid, family dramas. And I started to ask the following questions to myself, and I started to talk about them with my PhD students. So first of all, I started to wonder, how do we think about the impact of medical announcements on financial assets? And then second, how do we think about news about the diffusion of the virus, right, for the riskiness of different classes of assets? And finally, last but not least, if this is a pandemic, not just a local concern, should we think about global indicators in order to track this new risk factor, or local contagion news? These are just very natural questions that are interesting, in my opinion, both from an academic point of view and from a practitioner point of view, once you are in such a challenging situation. Okay, so in order to address these questions, we came up with 2 new data sets. One is a unique, comprehensive data set about medical announcements. This was necessary in order to address the very first question. How do I think about, Fauci popping up on TV and giving news about the pandemic situation? Is that something that helps the equity market? Is that something that systematically depresses the equity market, and so on and so forth? And in a second step, we build a novel and very broad, high frequency data set in which we provide a new way to measure contagion news. So we track newspapers, and in particular, we track the tweets about the news by major newspapers in many, many countries. Why? I'm going to be more explicit down the road, but the point is, by doing this, we can have a measure of the sentiment of potential sentiment of investors in many different countries. We can have it in real time, and moreover, by extracting all this news from Twitter, we can have it a very high frequency, even minute level frequency. Why is that important? Super simple. Assuming that all of a sudden, 5 years down the road, we're going to have another epidemic event, our technology is going to be able to capture a huge amount of observations within a few days of the beginning of the epidemics. And that's what you need in order to have decent empirical results. Okay. Okay, so let me go over the data construction, and let me anticipate to you that I'm going to have two parts in this paper. I'm going to talk about the first data set that comprises announcements, and then I'm going to talk about how we construct news. Okay, so 2 dimensions in this step. We collect health-related announcement dates and times, and then around these dates and times, we collect news production, diffusion, and tone. By production, I mean number of tweets by major newspapers. We don't have, thousands, billions, trillions of tweets, even by individual agents. We only track serious newspapers in each country. By diffusion, I mean number of retweets. It's our measure, if you want, of network diffusion, and if you want attention to this news. The tone has to do with a text analysis of the words that the newspapers use to take tweets. Let me anticipate that we use standard toolkits, but this is not a piece of cake, because no matter what, we're going to deal with 12 different languages in our data set that comprises, many different countries. But again, the interesting thing is that you can figure out whether the tone of the news that is disclosed is actually improving or deteriorating over time, even at a very high frequency. Okay, so for the announcements, what we do, we collect official press statements publicly available. We start with the Ministry of Health in each country, and we check whether there is a timestamp. Remember, ultimately, we want to figure out what happens to the equity markets and the bond markets around announcements. So we really need to have the timestamp of this announcement to process this kind of analysis. If there is no timestamp, then we go to the Twitter account of the Ministry of Health, and we check whether they tweeted something, and we look at the timestamp of the tweet or the content of the tweet. Sometimes you may have a tweet that announces that there is going to be a press conference within 1 hour. Hence, we can recover the exact timing of the announcement. And, if we are not able to do that, then we check major newspapers releasing news about official reports, again, in order to figure out at what time the announcement took place. Okay, what's the point here? There is a lot of effort. This process is computerized, but still time-consuming. Isabella, Mao, Paolo monitor regularly what the computer selects in order to find the effective date of the announcement. Okay, let me give you an example of what we're doing here. So this is, for example, a tweet by the White House issued at the end of January in 2020. You see here 9:41 p.m. This is Italian time, so we're talking about 3:40 p.m. If I remember correctly, January 31 was a Friday. In any case, it was a day in which the stock market was actually open. And, this tweet allows us to immediately identify the timing of the beginning of the conference. The timing would be, this started a minute and 24 seconds ago. So it means that they started effectively at 9:40. And in this case, just let me give you a little bit of disclosure. We go back, we check what happened during the announcement, and they gave both news about the conditions in China, but they also announced for the first time the 14 days quarantine policy. So the long story short is that we really account for both regular and sudden releases of news related to pandemic events. Think about it both in terms of disclosing what's happening to the number of cases in the country, but also disclosing about something about what authorities are about to do in order to limit cases. Okay, so this is just a summary table giving you some numbers. So we have overall 21 countries, nice mix of developed and emerging economies. We started tracking announcements in January 2020. By now we have, well, these slides are not updated actually. Up until May, we had 12,000 announcements, but we are running our further update right now. We're going to update the paper by the end of the month. So we're talking actually about, at this point, 16,000 announcements. And the majority of them, 85% of them, are only related to COVID. Just, preempting some questions from referees or whatever, some interesting questions that may pop up down the road. We also collected announcements by central banks and the governments about COVID-related fiscal policy and monetary policy. But again, we don't use them right now in the paper, and they represent a minority, okay, of the announcements compared to what we have. Okay, so in the next slides, I'm going to start to show you some econometric results, and it's going to be actually coming from something super silly. So ZT is the variable of interest. What we're going to do is to check whether there is a break by using dummy variables, okay, in the level of the variable of interest, or the slope, or the time behavior of the variable of interest, or perhaps the concavity or the convexity of it with respect to time in a window around the announcement. So just to be clear, we tested for post-announcement differences, and then we're going to depict the final results. If you see no break in our estimation, it means that nothing happened. If instead you see kind of a discontinuous function, it means that from a statistical point of view, the post-announcement, the dummy is significant. And again, it could be a dummy to the level, the slope, or the second partial derivative. Note, whatever we show you is the difference between the epidemic period and the normal period. So you should interpret this like a diff and diff. We always have the behavioral returns in normal times around the time of the announcement, say Tuesday at 10 a.m. versus what happened in the epidemic period. By epidemic period, I mean once the number of cases in a specific country became larger than 100. Okay, typical in our cross-section, and you remember, if you go back to March, February 2020, it took a little bit of time for each individual market to start to be concerned about the spread of the virus in China. It took time to figure out that it was really a pandemic event. And we have noticed that things started to change once the number of cases passed the threshold of 100. To be clear with everybody, we could, if you want, we could change this threshold and our results are going to be almost identical. Okay, so let me talk about equity returns and announcements. Okay, that's the first graph that we show you. Let me tell you what we have in each panel. Okay, the left-hand side panel is about advanced economies. The right-hand side is about emerging economies. On the vertical axis, I have the cumulative return that you would have if you enter into the equity market 60 minutes prior to each announcement, and you exit within 60 minutes after the announcement. Now I need to be clear which kind of announcements I'm considering. I'm considering an investor that can invest $1 in his own equity market ahead of each possible announcement during the trading day coming from his own country or the remaining countries. So if I'm in Italy, I'm allowed to enter into an equity position to invest in the market, in the equity market, 1 hour prior to the announcement that Fauci is going to give. 1 hour prior to the announcement that my government in Italy may give, and so on and so forth. And to be clear, here I'm allowing this agent based in Italy to invest in all possible equity markets. So this guy is gonna invest both in the US equity market ahead of a US announcement, in the US equity market ahead of an Italian announcement, in the Italian market ahead of the Italian announcement, in the American market ahead of an Italian announcement. So just to be clear, this is accounting for all possible spillovers that you could have just because you get a lot of news from a lot of different countries and locations. Okay, this is what I'm plotting right now. If you have questions, feel free to stop me. In a second, I'm going to show you also what would happen if you were to focus on a super simple strategy. The super simple strategy is that an Italian investor only responds to domestic announcements. So an Italian investor just enters into this kind of investment strategy ahead of the Italian announcements. So that's a little bit easier to digest that strategy. Okay, bottom line, this is one of the main results of the papers. It turns out that providing a regular news about epidemic conditions on average, this is an average of all the returns for all the possible days, for all the possible countries in this window. We just plot you the average and our fitted variable. On average, actually, all of these announcements are associated to an appreciation of the equity market. And if you're wondering what the units are, this is 1%, 0.1%, pardon. So these numbers are not multiplied by 100 right now. You can see that on average, you observe a similar jump in emerging economies. But what's special about emerging economies is that there is actually momentum. The appreciation continues to become stronger and stronger over the next 60 minutes. So this is what one way to think about this result from a theoretical point of view is that if investors just care about the timing or resolution of uncertainty, okay, if they just know about having information and they want early resolution of uncertainty, on average, to give them news will reduce their concerns, reduce their exposure to uncertainty, and cause an appreciation in the equity valuation. If there is a timing premium about information, then this result can be rationalized. There is a literature that tries to explain this positive jump for announcement about earnings or big macroeconomic announcements, like what happens on average in the equity market when you announce GDP, for example. And that literature has justified this positive jump through the lens of early resolution of uncertainty. We are the first ones to say, look, actually, when you focus on pandemic events, something similar happens also with announcements on medical. Something similar happens with medical announcements. Okay, so we have time. So unless you have clarifying questions, let me tell you the following. Let me open this page. This is what the same graph that I showed you before, identical graph. This graph simply shows you what happens if we focus only on days in which there are bad news. Now I need to tell you what bad news are. Bad news are days in which either the number of cases have been higher than expected. By expected, we do something simple. We compute the backward-looking 5-day moving average of cases. So if the number of cases is above the moving average, we think about that as a bad surprise. Or the other way in which you could quantify bad news is by using our text analysis that I'm going to show you later and figure out the days in which the tone of the tweet declined compared to the 5 average backward-looking moving average. Remember, the tone is constructed so that if you have good news with positive meaning, it goes up. So remember, I know exactly, according to this procedure, which announcement in which country has been an announcement that has provided unexpected bad news. I can focus only on bad news announcements and redo what I did before. And again, you see that there is a positive jump in advanced economies. The magnitude is smaller, not surprising, because remember, there is on the one hand the release of uncertainty, reduction in uncertainty, but also bad news about the evolution of the epidemics. For emerging economies, actually, the effect is stronger than what we have seen before. It just takes place with a little bit of delay, but you see that there is a strong appreciation. So remember, this is not just a story of prevalence of good news or some sort of systematic error in the beliefs or in the expectations, not at all. Even just giving bad news to the market helps participants through the lens of our assumption, helps participants to be exposed to less uncertainty. And for sure, you know, it's a fact, it's depicted here, it produces an appreciation for equities. Okay, next slide, you may wonder what happens if we focus on advanced economies, but not all of them, the ones that have a number of cases above median, so the most exposed to the pandemic event. And the answer is, the result is there, more or less the same magnitude for advanced economies. And the result is there even for emerging economies. And, you know, it's difficult to remember all these units, but the key point is that for emerging economies, actually, the extent of the appreciation is comparable across low and high COVID countries. Okay, so this is the other slide I promised to show you. This is going to be about local returns and domestic announcements. So let me show you what I have over here. On the left-hand side, I have what happens to bonds. On the right-hand side, I have what happens to equities. I'm pulling together all countries, advanced and emerging economies. And here I'm allowing an investor, say, located in Italy, to respond only to domestic announcements. So if there is an announcement in France, I do not take a position into the equity market or the bond market ahead of the French announcement. And what you see is that there is basically nothing going on in the bond market, pretty flat behavior. But for equities, you still observe a substantial jump. And the jump is half of what I showed you before. So it's just mechanical. What we're trying to say here is that the response of equity market to pure domestic announcement is as important, 0.5 on average %, as the response to all the possible announcements, including foreign announcements about the development of the pandemic abroad. In that case, the total jump on average becomes 0.1%. Okay, trading volume. Let me go over it very quickly. To be fully honest with you, we are revising the way in which we measure volume. So these results may change in the paper. Let me tell you what we show here. This is equity volume, so number of traded equities in this -60 + 60-minute window. Technically speaking, you can see that there is a decline in trading activity both in emerging economies and in advanced economies. In emerging economies, in log units, this is more pronounced. Let me tell you why I'm no longer a big fan of this picture. We looked at log volume, so number of traded assets, and what they do in the literature is usually to standardize this by the number of outstanding shares. That gives you an idea of really how much trade there is given the total amount of equities that are available in the markets. Together with my co-authors, we said, oh, come on, in such a small amount of time, it's very difficult to believe that the outstanding number of shares is going to change dramatically, so it's irrelevant. And that's correct. In the time series, it's not a big deal. But we made a mistake because, remember, we average all of this also across our countries. So we are effectively ignoring country level differences in the number of outstanding shares. That's a mistake. We're going to fix it. And that's because you may imagine that actually once you adjust for number of traded outstanding trading shares, that number is going to be much bigger in advanced economies than in emerging economies. That's my speculation. So I give you just a disclaimer. Here is what happens. Upon announcement, on average, equities appreciate. But at the same time, after the announcement, the trading declines. Okay, so now let me talk about long-term treasury bonds. I have already introduced a little bit out of the blue a graph with bonds. Now let me tell you that we replicate exactly the same strategy looking at fixed income assets. I see that there is something in the chat. Okay, let me read this question and then I'm going to go to the bonds. Okay, so bad news from one country may affect its trading partners' countries, which can be reflected into the market reactions. That's correct. So I wonder how our model account for the trading relation across countries and how fast the bad news travel across countries. If you're talking about trading of goods and services, it's a very interesting question, but I don't have an answer about that. If you are talking about how fast news travel just in equity markets, the answer is very quickly, because if I implement this strategy systematically with respect to all possible announcements, right? I showed you that the response of your strategy on average is twice as strong as the response of a local strategy. And most of that jump is realized around announcements. So my answer is it's a matter of just a few seconds / a few minutes if you think about emerging economies. Yep.
Thank you. Yep.
You're welcome. You're welcome. Okay, so what happens to bonds, right? That was interesting because the first thing that you learn is that on average, these announcements are actually good news for you if you continue to invest in a diversified portfolio of equity markets. But let's assume that you're risk averse, you're close to retirement, you want to have a safer portfolio, and yet try to have some yield. Well, here I'm showing you the same graphs for 10-year treasury bonds. Good news. The market value of bonds barely moves in advanced economies. And in emerging economies, actually, you know, if you believe in this estimation, you experience a little bit of an appreciation, a positive jump. So if you believe in this, around announcements, advanced economy treasury bonds are a wonderful edge. They don't move. Long-term bonds in emerging economies tend to be safe assets that tend to appreciate. Now, we conducted additional studies to try to figure out why bonds don't really react a lot with respect to bond news. And by the way, if I know this is not easy to remember, but the response of equities in emerging markets was actually much higher, much more volatile compared to the response of the bonds. Okay, that's why I'm saying they tend to be really almost insurance assets. We looked at also the response of CDS around announcements, and we found nothing. This is to say what? Here is what we were thinking. Assume that all of a sudden you face more epidemic uncertainty and you perceive the equity market as very uncertainty. You may be tempted as an investor actually to shift your allocation toward bonds. And so as a financial analyst, you would expect bonds to appreciate a lot around announcement times just because investors want to rebalance their portfolio. It doesn't happen. Now, there are two reasons why it could not happen. Well, perhaps we perceive bonds of countries that have a lot of cases not that safe anymore. Perhaps we embody the fact that there may be default due to fiscal constraints, okay? Or the other thing is that perhaps, prices are effectively kept stable by central banks. We studied the CDS and we show that there is very little action on the CDS for these bonds, okay, for advanced economies. Very, very little action from a statistical point of view, very minor, which is equivalent to say it doesn't sound like the price of the bonds are not moving because there are two effects going in the opposite directions. It sounds that it's mainly the reflection of central banks doing a great job of stabilizing also long-term yields. Okay, so at least that's our interpretation of these results. I talked already about these additional results, the CDS spreads, local returns, and domestic announcement. I'm not going to, for the sake of time, I'm not going to go over this slide, but basically we show that the muted response of bonds is there also with respect to local announcements. So even if you consider a strategy in which each investor, say located in Italy, responds only to Italian announcements. And the other thing that we document is the following. Here, I cannot plot really volume for bonds, but I can plot the bid-ask spread of bonds. Same kind of graph, post-epidemic minus pre-pandemic, pre-epidemic behavior, same day, same time, but I take the difference between days in which number of cases are above 100 and days in which number of cases were below 100. And what you see here is that actually there is an increase in liquidity right after the announcement in advanced economies. And that's what let us suspect that the muted response of bonds is driven by monetary policy. Whereas in emerging economies, what happens is that the spread tends to increase. So it's not really true that upon the announcement there is extra liquidity, okay? There is literally a little bit less trading, but the trading tends to be associated to a little bit of appreciation of the bond market. By the way, at this point, I would be wondering, how do I think about volume? And how do I think about these results? And this is a question that we get very often. And the answer is, unfortunately, I don't know, because we read all the recent theoretical papers that came out and tried to explain the behavior of trading around earning announcements. There is a lot of attention nowadays in finance to the phenomenon of the announcement premium. And so far, I could not find it pre-established, off-the-shelf model that could replicate these patterns. We are not done with our analysis of volume and trading. If our results are confirmed, then they represent a little bit of a puzzle for the trading models that we have. These are typically models in which they assume that there are multiple agents with disagreement. They have perhaps even private information. And then when the announcement comes, the announcement works like a way to mitigate the disagreement / mitigate private information. And again, no model reproduces our pattern so far. Okay, so we're doing great with time. If you have questions, feel free to ask. Otherwise, let me go over the second empirical part. The first part is all about trying to figure out what happens around announcements in a narrow window. Now we want to try to figure out what happens in the time series during the whole epidemic event. So we're going to have a high frequency analysis with a very large span. All the data come from Twitter, publicly available. In principle, if you have very good coders like me, you can gather all these tweets and replicate all these results on your own. However, I have two good news. We do have a web page with all of our data available, and we update it every 3 months. So you don't need to really build everything from scratch. And let me tell you why Twitter. That's because as opposed to Google, you can go to the minute level, whereas with Google, the most you can do is to go to an 8-minute level of frequency. And also, Google is all about, if you want, demand of information. It's all about searches initiated by investors/people, whereas Twitter has accounts for media, for newspapers. So we look at the production of information. Source, only major newspapers accounts, I told you. And why only major newspapers account? 2 reasons. Number one, it mitigates the problem of storing all of this data. Otherwise, you would just, the number of announcements would explode. Second, it prevents us from accumulating a lot of noisy tweets. Remember, I want to study also the tone of the tweets. I prefer to study the tone of a limited number of providers, namely newspapers, for a lot of good reasons. One of them is that I just consider them more reliable, and also the way in which they write titles and content of the tweets is standardized. So I don't have to worry too much about my text analysis software being tricked by the way in which someone is writing. That's all I want to say. Okay, some numbers: 21 countries and 85 newspapers overall, 12 different languages. We used to have 635,000 COVID-related tweets that we analyzed, and now we are almost at 1 million. Okay. Just visualization of the data, global perspective. Here I show you the number of tweets that we collect over our sample span. Here we stop at the end of April, but next time I present this paper, the slides are going to be updated. They're going to be updated to what's the end of August. You see this clear spike for the first wave, and then you see what happened during the second and third wave. My eye is trained. I can totally see the second and third wave. They were close to each other. Let me tell you what the size of this bulk of these dots means. It denotes the number of retweets, and so it's a measure of the attention, right, and the diffusion of this news. Incredibly high in the first wave, and then it declined over time. Here, just to make sure that we are all together, we show the frequency of the typical word that are mentioned in the tweets. You find what you would expect to begin with. These tweets were all about death, medical supplies. You probably remember there was shortage of ventilators to begin with, masks, and so on and so forth. Quarantine was extremely important, and then, not surprising, in the second part of this analysis, the vaccination campaign, and has become crucial. So, long story short, I would like just to convince you that our collection of information passes the typical smell test. We have also a lot of data at the local level. These are our countries. We have 1, 2, 3, 4 here. There is one missing in this chart. We couldn't fit it into the slide. Let me just add one thing. For each country, you actually see a thin vertical line. The vertical line denotes the period in which the number of cases in that country got about 100. So in the paper, we also tell you when exactly in each country the epidemic period really started. Okay, I didn't mention it before, it's public information. Okay, so let me go over the last part of this investigation. I want to really run a typical no arbitrage based model. I want to have a factor, okay, that I can register, that I can measure at a regular frequency, and I want to figure out how markets are exposed to this factor. It's not going to be a financial factor, it's going to be a non-financial factor. In particular, I'm going to have two measures. The first one is what I call the accounting measure, quote unquote objective measure. It's available at the daily frequency from the Johns Hopkins University. It's the number of confirmed cases. The second one is based on our measurement of the tone of our tweets coming from newspapers, and these are tweets about, the pandemic. We applied standard text analysis to these tweets, and we said that it's novel in many regards. Among other things, as far as I know, within finance, we are the first ones to actually collect a comprehensive data set also across different languages. Let me tell you what's, however, from a no arbitrage perspective, more interesting. Let me click on the slide. This measure, in my opinion, the tone of the tweets, tells a little bit more about the effective risk perception, in the sense that the number of cases during the second or third wave got a meaning that was fundamentally different with respect to the number of cases during the first wave. Why? We got more supplies. We also got better medical procedures. So even though the number of deaths tend to increase with the number of cases, in the later on waves, this phenomenon was less pronounced. Long story short, we got a little bit more used to this kind of announcements and what they meant for the economy. Okay, so this is the no arbitrage model that I'm going to estimate. Let me be brief. It's a conditional model. So you have a time varying beta. The beta is specific to portfolios of of countries with an above average number of cases, medium level and low level of cases. So we pick countries, we sort them according to their share of cases. By share of cases, I mean really number of cases, say in Italy, over number of cases in a specific day across the 21 countries that we have. The news are global news, so they are averaged across countries. And as I told you, they can be either daily news about global number of cases, so sudden increase across all countries with respect to what the backward-looking and moving average was in the last 5 days, or it could be a sudden adjustment in the tone of all the tweets across all of the countries. That's why these are global news. However, we postulate that the beta is going to be time varying and is going to be is going to have a local feature. In particular, this XFT is nothing else than the share of contagion cases for portfolio F at time T. So within Europe, you all know, guys, that unfortunately Italy had a pretty substantial number of cases compared to France to begin with. So back in the days at the beginning, the share of contagion with respect to the entire cross-section was particularly high for Italy. Okay, that local component is going to be captured here in this exposure. Finally, just remember, by no arbitrage, we can identify the market price of risk of this news, because the variation in the expected return should be totally driven by what's the name? The market price of risk times how sensitive our exposure is to the local conditions. That's it. End of the story. Okay, so I'm not going to show you a huge table in 13 minutes. Let me just give you the highlights. The first thing that we figure out is that global news are priced. In particular, the tone, news to the tone of the tweets has a positive market price. So all this means is that when all of a sudden we get good news as measured by the tone of the tweets from major newspapers at the world level, these are global news, that's a good state of the world. Remember, if instead we get positive news about cases from a finance point of view, that's a bad scenario because cases are above what we expect and it must be perceived as a bad state of the world. In that case, we find a negative market price of risk, okay? But at the end of the day, adjusting for the sign, the two estimates are pretty much consistent with each other. And the bottom line is that the market price of risk for this factor is really huge, substantial, both in advanced economies and in emerging economies. However, remember, this is not a financial factor. This is a non-financial factor. It's true that the market price of risk is huge, but it's also true that it's difficult to have a lot of exposure to it. Our estimated betas tend to be small. So this is to say that the implied risk premia that we estimate are kind of reasonable. I have already gone over this point. Look, we are actually the first ones to quantify with a lot of observations what the market price of risk of epidemic news is, huge but plausible because the betas are small. Our data set allows us to go beyond what you could do just using the John Hopkins data set. You can go also intraday. In particular, we decide to go with an hourly estimation. We don't go to the minute level. The results are confirmed and the inference becomes even sharper, which means our t-stats improve a lot. Not surprisingly, you manage to have to increase the number of observations basically by a factor of 8 because you go to the hourly frequency. Okay, so let me give you a list of additional results. I see that I have another 6-7 minutes. I'm going to go over this list of results and then I'm going to conclude with a nice graph. Okay, you may say, the no arbitrage model that you showed is super simple. At the end of the day, you had only a one-factor model there. You only had the global news about the epidemic. But perhaps your results can be fully replicated just by replacing global epidemic news with just global equity market news. So just apply some sort of global kappa n. So we did it. We took the Morgan Stanley Composite Index, the MCI International Index. We computed, unexpected daily variations there, and we replaced our news with just global equity news, and the model fails actually to be priced in the cross-section of countries, which confirms that our measures are informative about pandemic risk. The precise results are in the appendix of the table. You may say, this is all of the study is interesting. Okay, fine, we have a cool data set, but it's irrelevant. You know what? There is a simple story. You get news about the pandemic, people freak out, the VIX goes up. Why don't you control for the VIX? Super simple. We took our measure of global news. We regressed it over a measure of global volatility. Okay. Then we took the residual component of our news. The residual component, by definition, is orthogonal to volatility. We used global orthogonalized news in our no arbitrage model, we got the same results that we showed you before. So whatever we showed you goes above and beyond what you would find using equity volatility measures. There is something into this epidemic factor which is spatial compared to what you could capture just by using volatility measures. This bullet is also important. Remember I showed you cool pictures in which I was showing you tweets at the global level, but then I showed you that we have all of these also at the country level. Well, it turns out that since we have such a great granular data set, we can also compute local news. By local here, I mean news that are averaged only across advanced countries and across emerging economy countries. So we can split our global news component actually into two components. And then the other thing that we can do is to regress the local components on the common global component in order to obtain purely local components which are orthogonal to the common pattern across advanced economies and emerging economies. We can do here what people do in international finance. You just disentangle the pure group-specific news from the common news. And we found mixed results in the sense that the local contagion news are priced as you would expect in advanced economies, but local innovations to our, local contagion news are priced with opposite sign, whether you look at advanced economies or emerging economies. That's what I meant to say. As a result, this is for the same indicator, you have very different sign across the two groups. Let me also say that from a statistical point of view, however, we have very lousy results. These are just statistics that I would just dismiss. At least this is my view, not necessarily the view of my co-authors. Our results, I think, are very strong with respect to common global news. Local just news don't seem to be so essential. Next, I'm going to just show you the graphical visualization of our results, and then we can conclude. Okay, so what do we have here? We have the estimation of the expected excess return according to our no arbitrage model. So it's lambda times the time varying beta for an HML COVID strategy. So this is basically going long into high COVID countries and going short into low COVID countries. Okay. Okay, so in the left-hand side at the left-hand side of the slide, you see that I focus on advanced economies. At the right-hand side, I focus on emerging economies. For each group of countries, I focus on 10-year treasury bonds and equities. Okay. Remember, I'm focusing on a long-short position where countries have already been bundled in portfolios. So this is literally the expected excess return of this long-short position. And what do you see? Well, nothing really happened with bonds in advanced economies. If anything, if you squeeze your eyes, you see that the risk premium of these bonds declined at the peak of the pandemic. Bond issued by governments in advanced economies provided a little bit of insurance, which is consistent with the story I told you, looking at around announcement behavior. For equities instead, you see that there is a huge spike at the beginning of the first wave, and then you see an increased spike once the autumn came back and we got a very substantial second wave, both in the US and in Europe. you see here 2 lines. Let me tell you why I have 2 lines. The dashed line shows you what happens if you run our estimation just using local returns in local currencies. The solid line tells you what happens if you run your estimation when you after converting all the returns in dollars. So the solid line also includes the effect of the exchange rate. Okay, nothing really happened if you look at bonds, whereas here you see that the exchange rate adds on risk for countries with high COVID compared to countries with low COVID cases. What happened in emerging economies? Same general result, but I have to say on steroids, in the sense that if you believe in this graph, bonds provided excellent insurance. So this is a strategy in which you go systematically long in bonds of high COVID emerging economies and short in bonds of low COVID emerging economies. If you think that in emerging economies, sovereign bonds work as a hedge, they are subject to flight to quality, then this graph makes sense in the sense that bonds becomes all of a sudden assets that appreciate when times are very, very bad, and hence they should experience a lower risk premium. And for equities, everything looks the same. The only thing that I need to tell you is the following. Here we are putting together Asian emerging economies and Latin American emerging economies. So the graph looks differently because at the beginning, to go long in high COVID countries meant to go long into China and India. Then all of a sudden, the winter manifested itself in Latin America. You start to see the sharp increase. And then, this is what happened in the aftermath of the improvement that we have seen in the Asian countries up to March, end of March. Then you see that the cases restart to grow because of the epidemic conditions in India. I promise you, within a couple of weeks, I'm going to tell you also what happened in the aftermath of the diffusion of the Delta variant across advanced economies and emerging economies. But the long story short is that I think, I know I didn't show you standard drivers, but I think we have now both a text analysis technology and a data set for COVID that can be really informative about portfolio formation, at least for bonds and equities across 21 countries. Okay, my time is up, so let me summarize. Announcements, on average, move the equity markets upward. That's a fact. We think about it as, just giving information reduces uncertainty. Bonds are pretty much insensitive around announcement times, except in emerging economies. If you run a standard estimation of a linear no arbitrage model, you figure out that the market price of risk of the epidemic factor is very high, which means from a policy perspective, the containment policies are very valuable. That's something people don't discuss enough. Without lockdown, interventions, equity markets would have been much more depressed, according to our estimations. And fourth, I think it's an important side product of this investigation. We have a novel big public data set, which we hope you can enjoy, you can play with. My time is up. Actually, I'm long by 1 minute, so I would like to thank everybody again and stop here.
Yeah, thanks, Max, a lot for your fascinating topic. Actually, I really enjoy like the idea as well, like very innovative techniques. So let's go to the Q&A section. So in the chat box, actually we have 2 questions from Have8. I think the first one, if you like, you can discuss more, and Have8 also write another questions related to the long short strategies and how frequent you rebalance your long short portfolio.
That's actually a very good question. I don't recall, it's written in the paper. My recollection is that, you know, we went over this revision in April. My recollection is that the version you have seen today has a daily rebalancing. But let me tell you that relative shares, I wasn't precise enough. This is a relative share of cumulative cases. So the relative share of cumulative cases tends to be very, very stable. So this is to say, we don't have an incredibly high turnover of our portfolios, and you should not be concerned tremendously about bid-ask spread. Okay. At the beginning of the strategy, yes, there was a lot of switch of high shares versus low shares. And it was also related to the fact that the measurement of the cases was quite volatile. But as you compounded, the ranking of the countries became pretty stable. Yeah. You know, of course, at the daily frequency, it's not that India kept flipping across portfolios. It moved gently from, say, the low portfolio, well, the medium portfolio when the situation was under control. You remember we were talking about India like a miracle, even without vaccines. Actually, the epidemic was looking under control. And then, you know, slowly it went, India was moved to the high portfolio. But again, yep, that's it. In practice, the turnover of the portfolios is limited. Yep.
Thanks, Max. We're good.
Yeah.
Thank you, guys. Wonderful.
Yeah. Any questions?
This was super exciting. Thank you.
Yeah. Any questions? Please feel free to ask Max. Actually, before we waiting for the participants to have the questions, it's just like my thought that I listened to your presentations related to the news. Like you try to analyze. I read your paper, then I just wondering like any maybe like the bias related to the newspaper source. For example, like in the US, I saw like you collect the news from different newspaper, Washington, Wall Street Journal, New York Times. Then each newspaper, they belong into a specific party of the political view. For example, like some newspaper, they are very optimistic, but some newspaper, they are very pessimistic. Then I just wondering, maybe in the global scope as well. So that's the reason why I just like to comment.
This is a wonderful question. So let me tell you the following. Number one, I think you are tackling a very important question. There is a lot of heterogeneity in media, and we don't study it. The second way, someone should, perhaps eventually we will be required to do so. No, that's important. Even just you know, characterizing the bias with respect to epidemic behavior. Absolutely. For the sake of our study, I have good news, because do you remember that I told you I want to measure the sudden change in tone compared to the previous average? That procedure is done at the country level. So to the extent to which the newspapers are always the same and their bias tends to be a fixed effect, so, you know, CNN is systematically different from Fox. Thanks to the fact that I take the moving average within the country, I have eliminated the impact of the bias.
Yeah.
Fair enough, because, you know, it must be that either CNN all of a sudden got more positive, or Fox News got more positive for the tone to be higher than the previous 5 days. Equivalently, it's as if I'm eliminating a country-specific fixed effect.
That's true. Yeah.
It's actually fixed and time, because it's a 5 average moving average. You are right. If we were to consolidate everything across countries, we would have potential econometric issues. Yep.
Yeah.
You're totally right. Yeah, but within country, you know, so we look at this news within country and then we sum them up. We average them up across country. That's how we do it.
Interesting.
Yeah. Yeah, you said something interesting. We hope that this work can go beyond just financial economics. So we are thinking about how to share and visualize this data set better with people. So in principle, they could take advantage of what we did, precisely to tackle questions about news, media bias. Yeah, I know that's a big topic, especially in development and institutional economics. Yep.
Yeah, that's good. Even like the new bias as well, and sometimes like in some country they also censor the information of news. So that means like when you do for some Asian country like Hong Kong or something, that means you also need to kick them out for your sample and see like some country, if they have like that diversion of the news information, how they change your result. It could be like something interesting. It's my suggestion.
Yeah, you're right. No. It's a valid suggestion. You're totally right. And perhaps that's going to be, you know, the additional section that we're going to have in this manuscript. You're totally right. For Hong Kong, well, I should talk to my co-authors who live in Hong Kong. For Hong Kong, well, let me put it this way, more general, forget about Hong Kong. Let me put it this way, to the extent to which you believe that in some countries, authorities, control the tone of the news, but they cannot really control the disclosure of cases, then our results are kind of robust because we run our estimation both with number of cases and news. But if you think that countries where actually the crackdown on the media are also countries in which the number of cases effectively is not reported, then you're totally right. We should have a further split in our analysis. We should.
That's true.
I guess the good news is that you even find these results in advanced economies. Over there, you know, it's more difficult to think that the news are biased by authorities. They may be biased for political reasons, but not really because of the intervention of the government. So I will say, broadly speaking, what we find in terms of the market price of risk of this news being huge and the announcements being valuable, I will say that that's true. The fact that it's on steroid for emerging economies, maybe that's biased because of what you said. That's correct.
Yeah, thanks a lot. So we have one participant raised his hand, want to ask questions.
Yes, please go ahead.
Yeah, go ahead.
Thank you, Professor Max, for your very interesting presentation on a very new topics. Yes, I have two questions for you. The first question is, why I saw your presentation, I noticed that there are some results about the volume after the announcement, and the volume is decreased, right?
After announcement, that's correct.
Yeah. So it's a little bit counterintuitive for me that after the news, the announcement, the trading volume is decreased and the price is actually, the cumulative returns is actually increased. So could you please explain from
no, actually it's no, you have a good point. Let me restate it. First of all, we have not finished yet. Hopefully we're going to finish today. We must run again this analysis for a simple reason. We have not standardized the volume by the number of outstanding shares country by country. So effectively here we are mixing apples and potatoes, because trading true shares in a country where there are only true outstanding shares is actually a lot of volume. So first of all, these results, I must say, I'm not 100% confident about them. Second, you are totally right that if the pattern is going to be confirmed after we fix this problem in the data, we run again these graphs. If the pattern is confirmed, I don't have an explanation either. There is no model of trade that would prescribe a sudden decline in volume like we see here. I agree with you. I don't have an explanation. To be honest with you, fully honest, I hope that we just made a mistake to begin with, and after we rescale appropriately volume at the country level, the figure is going to look actually reversed. That's what I hope, because then I could cite work, theoretical work by other colleagues in the profession, and say, look, this is consistent with heterogeneous beliefs or private information and so on and so forth. As of now, this is a puzzle to me. Yeah, so I apologize. I don't have an answer for you. Yeah.
Thank you, Professor. And another question, if I have time, because you pursue very innovative ideas. So it's just about relating the research design. Before you start this project, do you think you will get some result, some very interesting result that you are presenting for us today? Because we are young researchers and sometimes we are afraid to start a very innovative research idea like you. So can you give us some advice for be more?
Yeah, no, okay.
courageous?
So now I'm gonna forget about being a researcher, and I'm gonna talk to you. It turns out I'm the director of the PhD program in economics and finance here in Bocconi. So let me talk to you like the director of the PhD program. Nobody has the crystal ball, and nobody knows whether you're gonna get the results or not. But don't be afraid, because it's not about getting results. It's about asking the right question. So, you know, all of a sudden we were all panicking and we were looking at Fauci, you know, in the US, or Borrelli here in Italy. And all of a sudden, people who were investing their money were wondering, what the heck is going to happen after this announcement to the equity market? They shut down Lombardy. So, you know, once you start from a relevant question that is related to reality, okay, even finding no adjustment is an important result, because you may go and say, look, we all got scared, we all got we all gave a lot of attention to these announcements, but once you look at the data, it doesn't seem as if they did anything. That would have been good to know no matter what. So I don't want you to think that we were expecting a positive appreciation of the equity market on average. Not at all. We just wanted to figure it out. And again, prior to 2020, I have never been exposed to any event, study, or article which was giving guidance about basic investment in a time of a pandemic. And that's what we did. That's what we wrote. You know, actually, there has been an explosion of papers written on COVID. This is one of them. We hope that we make a broad point thanks to the data set that we built up and the analysis of the announcements. But you know, there is no guarantee that we're going to have a lot of attention. We will let you know. I started with my co-authors just asking a genuine question that I think is important for society. And the other big point that we made is the following. Once you know what all of these announcements do to your equity market and bond market, by the way, then you should realize that these announcements and these policies are important not just to save life, but also to preserve wealth, which is a key determinant of economic behavior. I'm telling you, if you look at your retirement account and there is written in red minus 30%, You are not gonna go shop, or you know, you're gonna try to be, how can I say, frugal with your spending. If instead you manage to mitigate the collapse of these market valuations, automatically you're gonna help the economy and you're gonna help employment. So that's the other side of all of this investigation. So don't be afraid to just go for big relevant questions, and then the results are just the results. So you cannot cook them up, but the question is what you can choose.
Yeah, thank you so much, Professor.
You're welcome.
Yeah. Max, actually, when I listen to the discussion, I also think one point related to the news announcement. So let's say you take into account for every wave of the pandemic, right? So I just think from my reader's perspective for your paper, I think at the beginning of the announcement, the investor, they might be very reserved. They don't know what happened, what COVID is. But from time to time, they might like update their belief. Then their decision might be changed after from the second wave, the third wave, maybe the fourth wave, maybe after we have the COVID-19. Maybe people know what's going on. So maybe the market maybe change something.
You are asking a very good point, a very good question. So okay, let me go back here. You're saying, you know, maybe even the market price of risk, which is tightly related to the investor sentiment, is time varying. Okay, we could definitely estimate into subsamples.
Yeah,
we could do that.
That's true.
Or do it on an increasing sample. Okay. Yeah. We cannot at the same time have the lambda being specified as time varying and the beta as time varying, because then we have an identification issue. Okay, so in this study, you're totally right. We assume, it's an assumption, that the market price of risk is constant and all the variation comes from time varying exposure. Okay,
yeah,
that's what we assume. We can definitely do this in subsamples where the lambda is fixed within it, and yeah, we can do that. I think actually we did it, and I forget the results. I think that it stabilizes. You're right that it stabilizes after the second wave. I forget. Let me. Yeah, I made this one. I really forget it, and it's not in the paper. So let me make sure that when I talk to my co-authors later, so we add this as well. So, you know, the reason why I think that this is overall reasonable is that when you estimate with the tone of the news, right?
Yeah.
If all of a sudden these new cases don't really mean a lot, the news that I get minus the moving average that of the previous 5 days should be teeny tiny. So what I'm trying to say is that I think that our way to measure news of the tones partially capture, I mean, news of the tone of the tweets partially captures the backdoor you're concerned. So effectively, what I'm trying to say is that I don't expect this news to be homoscedastic in periods in which, you know, nothing special happens. They're gonna have low volatility. We estimate everything with GMM, with New West, so this is not a big deal from an estimation point of view. But the fact that these news don't move a lot implicitly affect the estimated lambda. Right?
Okay.
I think it happens through the backdoor. Let me check it with Paolo what do we have. Yep.
Yeah, nice. Yeah. So any questions for Max? So please. So I think if there is no further questions, so I would like to invite Professor Nguyễn Hoài, the editor-in-chief of Journal of Asian Business and Economic Study, would like to give some concluding remark and also send a thankful message to Max for deliver very excellent presentation today. So please, Professor Hoài.
Okay, thanks, Toàn. So on behalf of our journal, I would like to thank Professor Max very nice presentation, and also thank all participants attend the discussion and talk today with Professor Max. A very interesting topic. I think that I am not a financial man, but I understood that the topic definitely is related to the relationship between health announcement and financial impact. Luckily, maybe one more week later in Ho Chi Minh City, I mean Saigon, right now it's totally locked down. And 1 week later, we do hope that we will become new normal era with the existing COVID-19 in Ho Chi Minh City and also in Vietnam, because now we could not avoid absolutely the COVID-19 pandemic. So now we are living with COVID-19 in Ho Chi Minh City and also in Vietnam. So your topic is very interesting, and I think that our participants, especially researchers and lecturers, not only in our university, but also other universities, and not only Vietnam, but also other countries attended in this discussion will be applied for the context of our own city and our own country and their own countries. So, I would like to thank Professor Max for your time and for your contribution to the journal, and we do hope that we will meet you not only in Italy. I have been there several times, but Bocconi University I haven't been there, but I hope to be there. So in 2022. And I also do hope that I will meet you in person in Ho Chi Minh City and also in our journal office. And then we can have a more talk with your specialization regarding to medical announcement and financial impacts more. All right. So again, thank very much, Professor Max, and thank all participants. And we do hope that we will meet again in the next talk. Thank you very much.
Yeah, thanks.
I would like to thank all of you guys for attending the seminar, Tone for the organization, and who else was behind all of this big event. Thank you very much, everybody. I really hope we're gonna see each other. Actually, one of my dear co-authors is from Vietnam. Unfortunately, he got married in Vietnam exactly when I was moving from the US to Bocconi, so I couldn't visit. Looking forward to be there in your wonderful country. Yep.
Yeah, thanks.
And then about Bocconi, here you see, of course, this is in reality
very nice campus, right?
Yeah, it's a green screen. This is a feature of Zoom, but the campus really looks like this. We welcome, guys.
Yeah, we would love to be there. We would love to be there. Yeah.
Yeah. All right. So, yeah, actually, can all the participants, we can turn on the camera, then we can have photo shoot to take a photo for this moment. So could I start sharing? Max, can you start sharing? Then we can.
Absolutely.
Yeah, thanks a lot. Then we can, dear participant, if possible, please turn on your camera. Then we can have the photo shooting with the keynote talk today.
What do you do? Gallery view?
Yeah, gallery view. Then we have the like the photographer, the professional photographer to take the photos for us. So yeah, so look at the camera and say cheese. 1, 2, 3, trees. Okay. She's okay. Thanks a lot. So I think that thanks for your 1.5 hour very nice talk. So take care.
Thank you guys. All
Professor
the best.
Yeah.
Thank you. It was wonderful. You know, this is one of the good news about COVID. We can finally do this in Zoom, right?
Yeah.
It's better than nothing, and there is no stigma. It's wonderful. Nowadays, everybody meets on Zoom. Okay.
Yeah. Right. Yeah. Take care.
Thank you.
Yeah.
Bye.
Bye.
Thank you.